Hello everyone. So today we are discussing the critical issue that's currently happening in the Indian stock market. And recently we have seen a massive sell-off that leaving many investors in worry because they are seeing significant drop in their portfolio. So if you have invested in Nifty when Nifty was at its peak, then this current market condition might be a shock for you. So here in this video, we'll be discussing top 5 reasons why the Indian market is experiencing such a steep decline. So guys, one of the primary reasons for the market's fall is the aggressive selling by foreign portfolio investors, that's FPI. So these FPIs have been major contributors to the Indian market's growth over the past few years, but recently they have been withdrawing their funds in large amounts. In October alone, they pulled out 1.14 lakh crore, and November continues this trend with an additional 25,000 crore already withdrawn. So high valuation in Indian stocks and attractive investment opportunities in other markets, especially in China, have led these investors divert their capital elsewhere. So the another major factor is the strengthening of US dollar. So with the US economy showing resilience and the dollar index rising above 106, the rupee has weakened significantly, crossing 84.5 against the dollar. So a strong dollar places pressure on emerging markets like India as foreign investors tend to move their capital back to the US for more stable returns. This trend has intensified after Donald Trump's victory, which has caused the dollar to surge even further, adding additional pressure on the rupee and prompting more outflows. So, for the past 2 years, the domestic institutional investors, including mutual funds and the insurance companies, have helped stabilize the market by investing heavily, even as FPI sold off. However, the intensity of the FPI outflows this time is too high for the domestic investors to compensate. Despite 1.3 lakh crore injected by the domestic investors since October, the market couldn't withstand the sheer volume of the foreign withdrawals. This imbalance has played a significant role in the current market downturn. India's recent retail inflation data has crossed the Reserve Bank of India's upper tolerance limit of 6%. Initially, there were expectations that RBI might reduce the repo rate in its upcoming December meeting to stimulate growth. However, with inflation rising, RBI may be forced to keep rates high to control inflation, which is unfavorable for the stock market. High interest rates make borrowing more expensive, which can slow down economic growth and affect the market sentiment. Lastly, weak earnings in the second quarter of the financial year, that is July to September, have added to the market's woes. Many companies have reported disappointing results, highlighting the economic slowdown affecting the Indian economy. Had the corporate earnings been stronger, they might have helped stabilize the market. However, weak results have further shaken investors' confidence, leading to more pronounced sell-off. So, in summary, the recent market decline in India can be attributed to foreign investor exits, a strong dollar, the limitations of domestic investment, high inflation, and weak corporate earnings. So, these factors combined create a challenging environment. But remember, market cycles are a normal part of investing. So, stay informed and make decisions based on a long-term perspective. So thank you for listening. Keep your eye on the market's developments. See you in the next video.